What are business valuation methods, and why are they important to startup ventures? Well, to begin with, valuation is simply determining what a business is worth. And there are several reasons you do this. One, for tax and accounting purposes, particularly in the event you're going to issue some ownership interest in the company to employees or service providers through equity grants or stock options, then you have to keep track of that for tax purposes under 409A and for accounting depreciation purposes and reporting of income under Accounting Standards Code 718. Once again, this is an annual determination, so in summary, for tax and accounting purposes, you're going to need to determine valuation. And then, in the event you're going to seek investment from outside investors, you're going to want to determine what is the value of the business prior to investment and after the investment, because pre-money and post-money valuation is used to calculate how much money the investor is going to put in the business in exchange for the shares that they receive. So again, very important. Now, what are the primary methods used? Well, to start with, the base value of all the assets of the company is the floor valuation. That is the lowest the company would be worth, because in the event the company were to dissolve, it could just simply sell its assets. So you would look at the value of the individual assets held. But a startup, particularly in a business as a going concern, is generally worth a lot more than just the underlying assets. So you need to look to other methods to actually determine a useful valuation for the business. But again, the asset-based value is just the bare bottom, okay, or the floor. Next, you look at cash flow-based methods. Now, this is very difficult in startups because oftentimes startups are growing, and as part of that growth, they're not yet exercising their business model or not yet generating cash flow or cash flow commensurate with the value of their business based upon whatever other value metrics they may be creating, such as number of users or accounts or viewers, that type of thing. So once again, cash flow methods are useful for mature companies because you're taking future cash flows and bringing those future cash flows back to a present valuation. But for startup ventures, again, not extremely useful, but some combination of cash flow methods with other methods can be useful. And then finally, the most common method of valuation used, particularly in the investment scenario, is using comparables. And that's market comparables or deal comparables in that given market or industry. So basically, you're looking at other companies of similar nature in this industry or of this size and general characteristics, and you're looking at what their valuation was in deals, or you're looking at just the general understanding of what the market valuation is for a certain metric that they produce. And usually you're pulling this from other funding deals or other reporting structures. So you identify the value metric, whether that's revenue, whether that's growth, whether it's total number of users, whether it's account churn. You can use so many comparable metrics to take the valuation of another firm and identify that single unit of metric that you could then use to compare to your firm and draw a valuation from that. So these are the primary methods of valuation: asset-based, cash flow-based, and comparable-based. And these methods are used in different capacities and oftentimes combined and mixed for the purposes of tax and accounting, and particularly in valuation for investment deals.